I was going to read this article on Germany anyway, so I thought I might as well record my reaction and share it. So here goes. So it's on Bitcoin.com, and here's the title: More Signs the Next Big Financial Crisis Begins in Germany. Okay, it's a little sensationalist, and I'm not taking it completely seriously, but it seems like an interesting read, so here goes. Germany, the locomotive of Europe's huge economy, is entering a difficult period. Various indicators suggest, and when the Federal Republic sneezes, the old continent usually catches a cold. This time, Germany may infect the rest of the world as well. I mean, it is true, Germany doesn't seem to be doing as well recently. Europe as a whole doesn't seem to be either, so the stuff they're talking about is based on what's actually happening. Regulators in the country are busy drafting prohibitions, and now also seem to target cryptocurrencies. So they're trying to find a way to relate this to cryptocurrency, which makes sense given their title. A German economic and financial crisis would be a seismic event of global proportions affecting all markets. The main question now seems to be when it will happen, not if. Well, again, Germany seems to be not doing so well, though we'll have to wait till the hard numbers come out in a few weeks to know exactly how good or bad Germany is actually doing. Though again, if Germany's doing badly, it makes sense that the rest of Europe is going down with it, because Germany is such a huge economy in the place. And every European country is obviously connected to its neighbors. Biggest drop in a decade. German industry is hurting. The industrial powerhouse of Europe and the greater European Union is now seeing a significant decline in production, by 2.7% year-on-year in January, and 1.9% in April compared to the previous month. Germany's economy as a whole is not down 2.7% year-over-year. If they're talking about manufacturing, then okay, maybe. I haven't checked the statistics. So, maybe that's true, but if it's the economy as a whole, then those numbers aren't holding up. And if it's just manufacturing, then okay, manufacturing's a big deal, but the more important numbers are for how the economy is doing as a whole, not just one sector of it. Then in May, factory orders declined 2.2% from a month ago, and registered an 8.6% annual drop, the biggest in a decade. Okay, 2.42% is pretty bad, but it's only month on month, and these indicators go up and down on a monthly basis and have big movements, so it's not that big of a deal if it's like only a month. But if the 8.6% number holds, then yeah, okay, that's pretty bad and a big deal. In the first half of 2019, even beer sales were down 2.7% according to Dexterous, the Federal Statistics Office. I really don't care about beer sales. Okay, so this is an index of manufacturing orders. Okay, domestic orders are down slightly, and non-domestic orders are down by 10% since 2017, if this graph holds, and that makes sense because Germany is highly export dependent, and international demand is much more volatile over the long run than domestic demand. And there are structural issues in China and disruptions in global trade that are probably causing a huge decline in international demand. I mean, this is what happens when you power your economy by exports. You're very, very vulnerable to changes in the international environment. And again, I have a whole video describing why structural changes in China means it's just not going to import as much, let alone the fact that the Chinese economies also might be entering some sort of rough patch. We'll have to see. Okay. Yeah, as I was saying, international trade is being disrupted, and that's impacting Germany. International trade wars and geopolitical uncertainty in the region and beyond are negatively affecting the German economy, which relies heavily on exports. They form almost half of the country's annual economic output. Germany is Europe's leading exporter of goods, and it ranks third among the largest exporters in the world, after China and the United States. Several factors have been hurting German exports, which registered an annual decrease of 5% in April. Demand from China, which is a major market for German products, has been weakening due to slowing growth, U.S. tariffs on steel and aluminum are also a major concern, and the Trump administration is now considering whether to impose tariffs on European cars. Yeah, trade issues and slowing down in China. I've already talked about this, like a few seconds ago. Addressing the Bundestag last month, Chancellor Angela Merkel warned of a new global financial crisis as a potential result from a trade war with the US. She stressed that tariffs on cars will be much more serious than those on steel. Honestly, I hope... No, I'm not going to say that right now. The steepest slide in orders has been in the auto industry. Then there's the upcoming Brexit divorce with Germany has to deal with as well. And that's another issue that's adding fuel to the fire. Short working weeks are back. Against this backdrop, a growing number of German companies are reintroducing short-time work schemes, the kind that were implemented during the last global financial crisis to mitigate its impact on industrial expertise and the workforce. According to a survey conducted by the March-based Eiffel Institute for Economic Research, 8.5% of the companies in Germany's manufacturing sector expect to introduce short-time work programs over the next 3 months. So Germany's industrial sector is taking a bit of a hit, but we'll see how much of an impact the economy as a whole takes from it. This is the highest percentage since 2013. Deutsche Welle reported as last year only 2.6% of industrial entities were considering shorter working weeks for their employees. Germany still has one of the lowest unemployment rates among developed nations. Only 3.7%, 3.4%. Unemployment in the Euro area remains much higher at not 8% at the end of December. Shorter working hours are definitely helping keep the indicators as low as possible. The negative trends forced the nation's central bank to revise its economic forecast, taking into account the outlook for global commerce hit hard by the trade disputes between major players on the world scene. The Bundesbank now thinks the German economy will grow by only 0.6% this year. Since Germany's population is probably growing around 0.3%, that 0.6% number is really bad if it holds up. But we'll have to see what the actual numbers are before we can say for sure what's happening. The number represents a significant retreat from its previous prediction of 1.6%, which was announced in December. So I think we got the facts down, and the next part of the article will be sensationalist. Or more sensationalist. Financial meltdown brewing in Europe. The EU as a whole, and the Eurozone in particular, remain very diverse clubs of nations in terms of economic status. Some countries, particularly from the southern flank, continue to register double-digit unemployment rates. While Spain's economy is doing relatively well, Italy is practically in recession. Rome never managed to overcome its slow growth, and a decade after the 2008 crash, the Italian economy remained smaller than before the global financial crisis. Yeah, Italy has been doing pretty badly. I don't think that's really disputed. In May, a senior advisor to the German government shared with the BBC his fears that another European financial crisis could be brewing. He noted that Italy, which has the third largest economy in the currency area, is struggling to stay out of recession. It has to deal both with a banking crisis that can affect the euro and very high government debt, over 130% of GDP. A recession in Italy sounds bad enough, but a slowdown in Germany would be even more damaging. A full-blown recession in the Republic could definitely trigger a global crisis. So they say. Last year, Dr. Field was one of the first to warn that the largest European economy is slowing down. It actually shrank in the second quarter of this year, but while the government advisor is worried, the executive power of Berlin seems to be in a state of denial. So now we're getting into the politics of it. We are not in a crisis, Finance Minister insists. For now, no, but if the next 1 or 2 quarters go badly, yeah, you kind of are. Though we'll have to see what the numbers actually are when they are released. So, again, wait till we know what's the actual numbers are, and don't just make speculation before we know what's actually happening. In a recent interview with Bloomberg, German Finance Minister Olaf Scholz downplayed warnings about the negative outlook for the German economy and revealed that the federal government has no plan to stimulate economic growth. Again, stimulus will help in the short term, but it can only buy time. And if Germany's troubles are caused by longer-term structural problems, like overdependence on weakening trade, as they talked about, then it's only going to make things better for a short while before they run out of steam from the stimulus and things go back to the way they were. He believes that resolving man-made crises such as the ongoing trade wars and Brexit would increase growth rates in 2020, the year many now point to as the start of the next big crash. Insisting that more government spending now would rather lead to inflation than growth. Oh god, that's ridiculous. Inflation in Europe is so low. There is no inflation momentum. The economy has slack and room for stimulus. The Germans are... oh god. I mean, I just said that stimulus wouldn't only be a temporary measure and wouldn't solve Europe's problems in the long run. But at the same time, to think that stimulus could actually hurt, or that they could actually get inflation in this environment, is just ridiculous. The Germans are just not... they don't have both feet in reality, let's just say. We are not in a situation that makes it necessary or wise to act as if we're in crisis. We are not. Again, I don't want to sound too sensationalist. Who knows, maybe next quarter Germany will grow by like 0.3%, and they'll be back to 2% annual growth. So we don't know what's going to happen just yet. At the same time, it's not looking good at this moment. Germany's finance minister made these comments right after the European Central Bank indicated its intentions to increase its monetary support for the Eurozone economy in the coming months. Of course, interest rates are already at zero, so they don't have that much room to expand. I mean, maybe they could reactivate the asset purchasing program they scaled down, but I mean, it already wasn't doing that much, so we'll see if they have any more room for any action that would actually make a difference. Speaking to media in Frankfurt, EBC President Mario Draghi stressed that manufacturing in Germany and elsewhere in Europe may need increased government spending. In June, the European Central Bank indicated its ultra-low interest rates are likely to remain in place into at least 2020. You think? You think that they could... a rate hike would go down as anything but disastrous in this environment? 6 months longer than the previous stated goal. Oh, they were actually planning to raise rates by now? Oh, even we us in America are cutting. There's no way they get away with a hike in Europe without a disaster unfolding. ECB's management is also preparing for further cuts that will take interest rates into negative territory. Ooh, they're actually going to do explicit negative interest rates. Let's see how that works. I mean, you could get interest rates to zero, but... I mean, there's the zero lower bound problem, because if interest rates are outright negative, then people will just hold on to money under their mattress rather than keep it in the financial system. At least that's the theory. And who knows, maybe finance has become so digitized that you really can't do that anymore. We'll have to see if this actually works. So anyway... oh yeah, just what I was talking about. More quantitative easing is also on the horizon, which means printing more money. And purchasing more financial assets, just like I was talking about. Such policies would have a hard time winning support from the German coalition government, led by Angela Merkel. Olaf Scholz, who is also her deputy, believes the tax cuts that have been made so far and the infrastructure spending are working fine and additional stimulus would not be a wise idea. Oh, Germany has plenty of room for stimulus. It's the right move, even though it won't solve the problems facing Germany in the long run. It's still the right move. Though again, if they don't do anything else, then in like 3 years, the stimulus will run its course and they'll be back to the same situation in the first place. If the structural problems that are causing Germany's current funk, like structural changes in China and a slowdown in global trade continue, which they very well might. I mean, if global trade suddenly picks up and China suddenly demands a lot more goods and Germany's back in business. But that might not happen, and if it doesn't, then the stimulus will only buy time, and Germany will be back to where they started in like a year or two, even if they do stimulus. In essence, Frankfurt wants to bolster economic growth with QE and negative interest rates, while Berlin sees only rising prices as a result of these measures. Inflation is rock bottom. They can afford inflation to go up for maybe like a little bit, considering Europe does not have an inflation problem, and they're ridiculous to be worried about that at this moment. Too big to fail. If there's one thing Germany fears, it's inflation. Yeah, like a hypochondriac fears germs. Being a leading exporter of high value-added quality products, inflation of the Euro world will decrease its revenues. So would rising wages. And that's one of the biggest contradictions of the Eurozone, as countries like Italy actually need higher inflation so that their exports remain at least price competitive in relation to Germany. Ugh. I don't know if this needs repeating, but the one-size-fits-all euro was a horrible idea. Berlin has gotten itself and the rest of Europe into an almost hopeless situation. The Eurozone is tuned in a way that benefits its largest economy. That, however, leads to a concentration of money in Germany, whose banks have been lending it back to the weaker partners in the Eurozone and EU to sustain them in their markets. Sooner or later, the poor borrowers won't be able to take any more debt. It's already happened with Greece, for example. Germany has been a lender, supplier, and consumer that's too big to fail. A German crisis would surely drag down the rest of Europe and hurt the global economy. Again, I don't know necessarily if German stagnation or even mild recession would actually translate into an actual crisis that causes some sort of financial buckling or whatever. But whatever, that's what they seem to be sensationally claiming in this article. I mean, maybe they're right, but I don't see it necessarily happening that way. So now Europe is basically financing Germany through low and sub-zero interest rates. Things are nearing a point where normal economic logic isn't a part of the equation anymore. Investors are literally paying more and more to lend money to Germany, as Walt Business editor Holger Zachpitz, I apologize to the guy for butchering his name, remarked in a tweet this week. Berlin recently sold 2.345 billion euros of 10-year debt at a record low yield of negative 0.4%. Oh, good God. Germany has had negative interest rates at like the height of the Euro crisis. But good God, a yield of negative 0.4% on a 10-year bond is ridiculous. And inflation in Germany is 1.7%. So the real interest rate is negative 2.2%. Good God, only like a few months ago, 1-year yields on US bonds were paying a yield of 0.5% adjusted for inflation. So that interest rates in Germany are yielding negative is just... Oh, this is just ridiculous, as I said. I mean, you'd think at this point they'd just not buy bonds and put the money under their mattresses. Or, I don't know, invest in US assets. I mean, there's an exchange rate risk, but at least you're not guaranteed a 5% loss. Actually, it's a 2% loss in real terms. So back to the article. Whatever the German finance minister says and does, there's the well-grounded feeling that the next big crisis is looming. The troubles of Deutsche Bank, Germany's largest financial institution and top banking services provider, are proof that something is wrong with the traditional financial system. Okay, even if the finance system is having a few minor troubles because of Germany's economic slowdown, and even if that slowdown actually becomes a recession, which, again, isn't in the cards just yet, and we don't know exactly how good or bad Germany's economy is doing, but even if that happens, that doesn't mean it's going to translate into some sort of financial crisis. I think they're being sensational, as I said before. But let's see what they have to say again. The fact that the central banks brought a record 15 billion of gold in the first half of the year, and German investors bought into gold buying exchange trade funds, as the Financial Times reported, is a strong indicator of the effects of efforts to diversify away from fiat currencies. Oh, that just says that Germans are hypochondriacs and inflation phobes. Nothing else. In Europe, we have a dysfunctional monetary union. German finance strategist consultant Mark Friedrich told Bitcoin News. German finance strategy consultant Mark Friedrich told Bitcoin News. The South suffers with the euro and will never get better within the euro, the economists emphasize. Again, they're trying to downplay the euro because they're Bitcoin, so they want to play up Bitcoin. And to do that, they need to downplay the euro and encourage people to sell their euros to buy Bitcoin. So again, this source is a little biased, but still, they're right about a few points, so you have to take them with a grain of salt, but what they're saying isn't complete garbage either. Again, it's based on a lot of true facts. Friedrich thinks the recession is already coming. Again, we'll have to see if the slowdown actually gets worse and actually goes into a full-blown recession. That's not in the cards just yet, and we don't know what Germany's growth numbers will be in the next 6 months at this moment. In its aftermath, a new monetary system will be born, a digital one in which societies will need to decentralize current... Like what I said, the euro's kaput, so sell your euros now and buy Bitcoin. It's completely sensationalist. There are a few points in this article based on truth, which is why I'm reading it and commenting on it. Unfortunately, German regulators are making it harder for crypto businesses to operate freely in the Bundesbank. Yeah, I'm just going to skip this crypto garbage. I'm not saying cryptocurrencies are garbage, I'm saying this part of the article is garbage because it's just naked self-promotion rather than objective analysis. Oh, and we reached the end of the article. Well, again, the point's that the economic numbers for Germany right now are not looking good, and maybe things will get worse. But there's not going to be a full-blown crisis. At the same time, there are points about Germany's overdependence on trade, the fact that their economy's taking a hit because the growth engine they depended on is running out of steam because of slowing global trade and structural changes in China. And the rest of Europe has been doing even worse, so... I mean, they're right about those border points, even if they're sensationalist and projecting into the future when the numbers aren't completely in yet. Okay, so that's this article. I hope you enjoyed my analysis of it. Please like this video and subscribe to my channel. Share this video if you thought the article was interesting. And comment in the section and give your thoughts.